Hello everyone. Thank you for attending. This topic will be the real estate forecast 2022 and beyond. Thank you. Welcome. Thank you for watching. My name is Si-Wing Yi from the Yi Real Estate Network, and my guest host is Mr. Richard Advani from Supreme Lending. He is one of the leading real estate loan consultants in the country, and welcome aboard, Richard. And right now, today, we're going to talk about the big picture about what's going on. We can talk about a little bit about what's going on. Then let me share my screen, and then we'll get it started. If I could find my, you see the screen right now?
Yes.
Okay, so let me. All right. So without further ado, let's talk about this. Let's talk about the supply and demand, which is really economics 101 or real estate 101. Whenever there is more demand to supply, then we will see prices gonna rise. That's how it goes. This past year, according to some sources, there's a need for 3.8 million homes in a country to meet the demand this past spring, and we only are providing a little bit over 1 million supply of homes. So it's a big disparity, 1 million supply of homes versus 3.8 million that are needed for this year, 2021 alone. Furthermore, the next few years, according to some other sources, is right here, a 6.8 million housing shortage. I mean, this is totally mind-boggling. So this supply chain challenges is continuing to be very challenging. One more information here. I mean, people think that we have a severe supply shortage just this past year or past 2 years since the pandemic. No, the pandemic, I've seen it, Richard, you've seen it as well over the years. Ever since the housing crash in 2008, at that time there was an oversupply of homes. At that time, the builders are not building new homes between 2009 to 2021 or whatever, right? And a lot of those builders went out of business, and a lot of the construction workers, they left the industry. So not only there's a lumber shortage right now, there's a supply chain shortage, labor shortage. So it's just causing some problems. As you can see, from 1968 to 2000, that's we needed about 1 million homes per year. But then when the last 20 years, where things have started to change, starting in 2001, there's a 1.3 million homes are built annually. There are now 147,000 homes that are built annually, but there's 1.3 million homes are needed. And then now, as we move forward from 2020 to 2030, for the next 10 years, there's a need for $2.5 million new housing units, but we're only able to supply barely over 1 million. So and then Forbes magazine recently said the housing shortage is worse than ever, and it will take a decade of record construction to fix. And then now we talk about supply, demand. Look at the many markets. I'm just using the Austin metro market recently. There's only like less than 1 month supply of homes. So in Austin area. So it's pretty much indicative all over the country. Doesn't matter where you live in all 50 states. The supply of available homes is like 1 month, maybe slightly more than 1 month. And we all know 6 months is a normal market, but we're not reaching 6 months. So I see there will be a long while before the supply of homes will catch up with demand. So, and then here's a nice nice graphic I just found a while ago. And the buyer to the left is we really like to look at something a little higher priced. And the realtor said, okay, I can show you this house again tomorrow.
I love it.
Absolutely. So let me finish up the slide here. Again, the inventory supply has been decreasing systematically. And this is just an Austin income the core of Austin, where the median price inside downtown area is like almost $600,000 recently. This is shockingly
Wow.
amazing. A few years ago, I've been promoting Austin for the past 10 years, Richard. And a few years ago, the median price in Austin is half that much. A few years ago. So anyway, so that's all I have to say on the demand and supply chain situation. So for the rest of our podcast, Richard, I'm going to ask you to talk about pick a topic for the remaining topic: interest rate situation, affordability, rising cost of rents, and the millennials at peak buying years. Go ahead, Richard, share with us your thoughts, since you are not only your loan consultant, but you help investors over many years to buy in a good markets, I presume mostly in South and Southeast and in the Midwest. A lot of your loans, investment loans you have done. So you talk to investors a lot, you follow the market. Since you're a loan agent, you follow the economy, the interest rate environment, what the Fed is doing, and all those stuff. So I know you're not an economist, but let's do the best you can. So go ahead, take it away. What you got? What are your thoughts?
Yeah, I mean, we'll talk about interest rates first. Obviously, interest rates over the course of the last 45 days have really been on an upward rally with the 10-year Treasury bond. Now, that doesn't mean rates aren't good, though. They're still pretty phenomenal. 25% down still gets you in the high threes on an investor conventional loan. 20% down pushes to, the high threes to low fours. But, generally rates will cycle upwards and then cycle downwards. And, as of this morning, the Treasury bond is down 4%. So, whether that's going to continue and rates kind of cycle back down a little closer to where they were, we'll find out. But that's in the near term. In the long term, over the next 4 to 6 months, rates are projected to go up. So, now's still a good time, as good a time as any to lock in your rates while they're still low, make up for some of those higher house prices. Those were really cool kind of statistics you showed on that PowerPoint, because you're talking about having 1.5 million home shortage still in the next 5 to 10 years, which, I mean, it really means to me that, the housing market is going to remain robust. And, even if rates move up a little bit from here, even if they move up 1%, there's still so much demand versus supply for housing. And as rents move up, which has been great for all of us that have owned properties for a while, what you're seeing, though, is in a lot of markets, it's almost getting, I wouldn't say cheaper to buy, but that delta is getting closer and closer. So, the strength in the real estate market, I think, is going to continue. As you know, Seawing, we offer a non-traditional program that's really based on the asset itself. It's not even, you don't even have to have income documentation. And the fact that that program even exists, to me, says that, these hedge funds and larger companies that support these programs really have that much faith in the collateral itself, right? That 20% down that you're putting on the property, on a cash flowing investment property, is enough security for them to not even look at your income documentation, because they know if you default, not only is, the market still going to support that price, but they could potentially put it in their own portfolio and, have it be a cash flowing rental. So, the people that are, smarter and have more data than you and I, in my opinion, still think the housing market has room to run. And, people ask me all the time, though, well, what if values drop 10% in the next 2 or 3 years? And hey, maybe they will, right? Historically, they're going to keep going up, even though they cycle like this. But I mean, first thing is, most of us are investing a little longer term than 2 or 3 years. So it doesn't matter what someone says the home's worth, right? It's rented out. You're getting the cash flow. Prices drop 10%. Boo-hoo, they're going to go up 10% 2 years from then. The other thing I'd say is, if prices drop 10%, I'm going to buy more, right? Dollar cost average. I mean, it's a good opportunity to buy more. Real estate is a long-term investment. So, where you buy in the cycle, sure, we all want to catch it at the bottom, but trying to time that keeps you on the sidelines more than anything else. And you miss a lot of action, because none of us can really time the market with stocks, with crypto, with real estate either. So, dollar cost averaging is a good play. And if you're in it long term, even if you buy and 5 years later it dips a little, well, you know, trust me, 5 years after that, you're going to be higher. And after the last crash, there were a lot of people voluntarily short selling their homes and giving them up because that's what everyone was doing. And because, you know, they may not have had equity in it anymore. And a lot of those people still had rental income coming in and cash flow coming in, and they still went down that path. And, you know, 3 years later, home values, 4 years later, were back to where they were. And then they've gone up significantly since. And, you know, I guarantee 80% of those people regret getting rid of those properties, and they panicked and sold, you know, just like people do with stocks. But yeah, I mean, I think paired with the still historically low interest rates, now's as good a time as any, you know, get off the sidelines, as I keep saying. And, you know, I keep looking at opportunities across the country too. And it's tough out there, but it's not either. You know, if you look and, you know, if you leverage a group like Sea Wings and, you know, have the connections and have the markets already set up, there's still a lot of good buying opportunities out there.
Exactly. I agree with you. It's a buy and hold long term, you know, keep your profits forever. Because, you know, the next topic in align with what you just said is all about the rising cost of rents and the affordability factor. Now, before we go into details, I mean, I know I tell my investors, look, we are promoting single-family home rental properties in Raleigh, North Carolina, and Southwest Florida, Cape Coral, and in Central Florida, and in Central Texas, outside Austin, and you know the corridor Austin all the way down to San Antonio. That 100-mile radius is booming. I mean, when I tell investors, oh, we have new construction costing like 250, 300K, 350K, then some of my investors are thinking, oh, well, you know, you sure it's the right time to buy investment product because prices have gone up so much. But then you have to look at the rent to value ratio. The rent has dramatically increased as well. So renters are paying more rent now. Like a typical $350,000 homes in Raleigh, we're selling for. We have a renter paying like $2,200, $2,300. In Cape Coral, Florida, our property like in $340K right now to single family home new construction, and some of our investors they just put their house for rent after they closed escrow recently. They're renting for $2,400. You do the numbers, the number makes sense. And then same thing with Austin, outside Austin. Now we have homes for $250, $200K in San Antonio, New Braunfels, Temple. I mean, it's being rented for $2,000, $2,200. So 0.007 rent to value ratio, not 1%, 0.007% multiplied by the purchase price, then you will cash flow on your homes. Now let's talk about affordability. Now, a lot of people in the country, because of rising prices, they can't afford to buy anymore. You know, we see it all the time. I sent you a short video on the Southern California Inland Empire where you live, where the rents are skyrocketing 10, 20, 30%, recently. Same thing up here in the Bay Area where I live physically in the San Francisco Bay Area. Rent has skyrocketing, $3,000, $4,000, $5,000 rent, or the house is barely 3-bedroom, 2-bath, like 1,300 square foot. So a lot of people cannot afford to buy. They're relegating to renting. So that help investors. They help our investors, right? So with cash flow. So what are your thoughts about the skyrocketing rent and the overall affordability factor, not just for renters, but for people, first-time homeowners that try to buy in different parts of the country, they can't afford to buy because of rising appreciation and rising rents. I mean, shortage of homes to buy, shortage of homes to rent. And this challenge will go on for a few more years, I think. So what are your thoughts around that?
I think I'm happy I have as many properties as I do, because we're really this last year, and anyone who owns real estate, especially investment real estate, will attest to it. We're really seeing how real estate is a good hedge against inflation, and a 30-year fixed, excuse me, is such a good hedge against inflation. I mean, we're printing money to keep the economy going the last couple of years. What do we think is going to happen, right? The cost of bread, the cost of lumber, the cost of everything has gone up 30 to 40%. And along with that, the cost of homes. And guess what hasn't changed if you have a 30-year fixed mortgage? Your monthly payment. And that's how wealth is built through real estate is, it's setting aside the cash flow and everything else. I mean, on average, and it's obviously the last year or two is dramatically higher, but on average, inflation is what, 2-3% a year. So over 10 years, your money is going to be worth 30% less. The bread's going to cost 30% more. That's in a best case scenario. Really, it's been hundreds of percent that things have gone up in the last 10 years. But what's not going to change? Your 30-year fixed mortgage payment. 30-year fixed do not exist in other countries. Just because it blows their mind. How can you have a fixed rate for 30 years through no matter what economy is going on, factoring in inflation and everything else? I mean, if you're getting a 4% 30-year fix on a rental today with how inflation's been lately, it's free money. And if you've got 100,000 in your bank account right now, in my opinion, with inflation the last 2 years, you probably lost 20 grand with it sitting there with your buying power of that money, so deploy it, put it to use. There's really I've been investing in real estate for about 12 or 13 years. And I've always experienced, the cash flow. And now that you're 10 years in, you're paying down your balances quicker, but I haven't really experienced the hedge against inflation part of it until recently. And you can really see it because rents, you may have bought a property 6 years ago for 300 a month in cash flow that made you 10%. Well, now rents have gone up 300 in the last 16 months. Your rents have doubled. Your cash flows doubled, so, it is long-term. And if you look at real estate long-term, when we print money like we did, instead of being panicked or nervous, they're going to be like, okay, great. I know what's happening to my rents next year because of inflation. So, I don't know if things are going to get any better anytime soon. The Fed still thinks inflation's transitory, although lately maybe they're agreeing it's not so much, but the cost of goods will and always have gone up and they'll continue to go up. And there's no better hedge against that than real estate.
Absolutely, Richard. I mean, I try to continue to educate my investor database and you as well. So we are the pioneers. It's our responsibility to get the message out. Just don't worry about all the short-term fluctuations, all the naysayers out there, and all the doom and gloom people try to paint the picture. If you watch a YouTube video, the most operative word is the word crash. I do not see a crash coming, just a slight correction. I mean, in our forecast, you and I, 2022 and beyond, we're not going to get rampant appreciation like we do in certain markets like Boise or Austin, like 50% appreciation in a mere 1 year. That was last year during the pandemic. But we may see some moderate appreciation, 7 to 10% in most markets. But because of the reason, because the interest rate is continuing to be, historically low, demand and supply issue will continue to be a challenge. And then finally, the millennials. It's so funny. My son is part of the millennial age. He's age 30 years old, and he's motivated to buy a property here in the Bay Area himself. So he's a perfect example of millennials. They are ready to buy, right? They are moving out of their parents' home. Their job has gotten better. They're getting more salary increases, and the millennial gonna run the market for the foreseeable future. And that will only exacerbate the supply and demand issue. So still right now, still a bidding war, still a multiple offer situation all over the country. Not like the 150 offers you get in Austin last year. No, you're not gonna get that. Maybe 5 to 10 offers per house these days. Maybe 5 to 10% above asking. So that's the game we're still playing. All right. So I think we addressed a lot of issues. You have anything else to say about the millennials? So you are part of the millennials, Richard. You have friends and relatives and even clients that your age that are very motivated by homes, but there's not enough homes to buy out there right now. So what are your thoughts?
Well, I mean, on the point you just said, just I wanted to add, talking about appreciation too, and how appreciation is going to slow. Notice right before that whole rant about inflation and all that, and how, you could build wealth through real estate. I didn't even mention appreciation once in there, and appreciation is definitely, we all want it. It's a bonus. We're in the get rich, quick culture, set that aside and make good real estate investments that perform well in strategic markets. And when the appreciation comes, great, it's going to be a bonus. But even setting that aside, let's say the property didn't appreciate. Okay, let's say it stayed flat for 6 years. That's never happened, but let's say it did, right? Everything's gone up so quick. Value stayed flat for the next six years. Just on cash flow, just on paying down your balance, and just on inflation, you're going to still be able to build wealth on that property over the long term. And appreciation will come. Obviously, property not appreciating for 6 years has probably never happened in this country. But, even factoring in the cash flow, the fact that your return on amortization, you're paying down your balance, plus the hedge against inflation, real estate to me is still a good win. And yeah, you can throw 30 grand and roll the dice and crypto or in stocks. And I'm not saying not to invest in those things if you have enough capital, but if you don't own any real estate in your portfolio and you're playing with all these volatile things, I mean, the stock market too. I mean, it's the biggest stocks, billion-dollar companies go up 6% one day and down 3% the next. Is scary as real estate is for everyone, it doesn't happen. It doesn't happen overnight. It takes time for that to happen. And, have a balanced portfolio, but if real estate's not in there, you're really cheating yourself.
Yep, Richard, I totally agree. With that said, I mean, you provide a very good high-level explanation. And so once again, investors out there, you need to get motivated. You need to get some commit to your goals, get some inspiration, look at yourself. I mean, and above all, take action. Just don't worry about all the doom and gloom, all the negativity out there. Focus on your financial plan and take systematic steps to create your real estate portfolio for the next 10, 20 years and retire financially free. So, all right, well, I think that's it very much. Unless you have something else to say, Richard, this concludes our presentation, the real estate investing forecast for 2022 and beyond. We feel very, very positive. And just think long term, buy and hold and write out any short term things. So at the end of the day, you're going to be happy that you did. Thank you so much, Richard Advani from Supreme Lending. Once again, and this is Si Wing Yi from the Real Estate Network. Have a nice day. Goodbye.